Good morning, everybody. Welcome. So I am very happy. So my name's Lynn, as you guys know, and I am very happy to have Ed Jones with us today. Ed, thank you so much for joining us.
My pleasure to join. Not sure how Tracy talked me into that.
I know. So Ed is a wonderful CPA. He actually is the CPA for almost, I think, our entire team.
Everybody.
Everybody. So Ed is here. He is joining me as co-host today. But more importantly, he is here because he is going to talk to us about some changes in the, taxes when it comes to real estate, specifically the 1031 exchange, which we're going to be getting into in a little bit. But so Ed, how's your week going?
Oh, completely peaceful. Nothing going on at all. I like to look out the window. It's tax season.
I know.
Working 80 hours a week. We're still waiting on numerous things to do with the PPP in regards to forgiveness that hasn't been decided yet in the states. This most recent act that's been passed with Biden has changed some of the stuff that's already been filed. It's an absolute cluster. But, we'll survive.
Yes, and you always get it done in a
Oh,
very
yeah.
timely and efficient manner, must I say. Because, I mean, I know, as I mentioned, I work with Ed, and we're good to go.
We're done.
We are done. I have never in my life been done my taxes this early, except maybe last year and the year before when I started working with you, which is, it's a nice, it's one of those stresses that you don't realize you carry until it's done. And then you're like, oh, worth every penny.
Although if you don't have your taxes done yet, don't blame your poor preparer. I have many clients who are not done yet, especially on the corporate side, as we're waiting for more guidance.
Yes. So always has to be some kind of bureaucratic red tape that holds things up, isn't
good
there?
God, yes.
Yes. So, well, again, so Ed, in a little bit, he is going to, he's our guest today, coming in to talk to us, like I said, about changes to that 1031 exchange when it comes to real estate. So definitely pay attention and share this if you have any family member or friend who this could affect. So we're going to get into that in a minute. But first, we're going to break down some Northern Virginia news for you. I also want to point out that we do not have our fancy smancy slides today because we were having some technical difficulty with the computer, but that's okay because I have all the information for you, so just pay attention. But first, so in Northern Virginia news, over in the Manchester Lakes neighborhood or shopping center, Amazon Fresh grocery store is supposed to be coming in there, so that's going to be really interesting. It's actually very different from Whole Foods, and it's going to be one of the first ones in this area. So that's going to be interesting to see what that does, what it's like. It's definitely inching closer to opening. I don't have a specific opening date yet, but it is going to be over at Festival at Manchester Lakes, over in that Kingstown area of Springfield. So make sure to keep an eye on that. I will keep an eye on that, so I will let you guys know once it does actually open. The other thing in good news is for a while now, UVA has really been partnering and working with Inova Hospital to bring some of that medical training up into this area. So UVA Inova campus just opened. It's a regional medical school, and right now they have 36 third-year students. So that's going to be, a really good incubator for that medical field in this area. And it's also really nice because you've been seeing a lot, obviously with Virginia Tech opening a campus out where the new Amazon second headquarters are going to be. You're really seeing a lot of these big universities from Virginia kind of moving in and giving options for this area. Now, Virginia Tech and UVA have always had some type of satellite campus up here, but this is really where they're really pinpointing and focusing on those specific fields that are coming into the area. So that's exciting. That has just come up. And do you get out and walk a lot? Are you a walker?
Outside of tax season, yes. My My dog enjoys a good hour walk around the neighborhood, so we
Wonderful.
try to when we can, when it's not freezing cold
Yes.
or tax season.
Yes. So, yes, freezing. I don't do anything in the freezing cold. I stay inside and put on lots of clothing. But so if you are in the Alexandria area, they have just, through the Alexandria Commission of Arts, they are doing public art installations throughout the trails in Alexandria. So that would be, just a nice, it kind of gets your creative mind thinking as you're on a walk, because you're going to be walking through the different trails throughout Alexandria and see local artists' wares and sculptures and everything alongside those trails. So I think that's something that's really kind of cool that's happening out there.
I'll have to check it out after April 15th.
Yes. Yeah. Or 2 months after, maybe, if they do an extension.
You're right. Why, Lynn?
Your timeline is getting longer and longer. I know. I'm sorry. I'm sorry to be the bearer of bad news, but it might happen. Also, specifically in the Alexandria area, but, in general, but just because Alexandria sits in that low water table area, FEMA is actually redoing their flood maps. They haven't redone this in the past 10 years. So, especially if you're in the Alexandria area or in an area that tends to flood, or you're in that low water table, they're going to be updating that. So you want to really specifically keep an eye on this and see if your property's flood rating changes, because if it does, that's obviously going to be affecting not only the fact that you might get flooded, but it's also going to affect your insurance. So they are in the process of updating that over the past 10 years. So definitely make sure to keep an eye on that to see if that is affecting your property or not. And then lastly, keeping the news a little bit short today, because I want to give Ed a lot of time to be able to explain everything he's come here to talk about. But exciting news is Caboose Tavern over in Vienna. They also have Caboose Commons over in Merrifield, but the Vienna location just launched a breakfast menu. I am huge. If you've ever watched this show, I'm a big breakfast fan. But so they have just gone ahead and announced they just launched their new breakfast menu. So, biscuits, bagels, sandwiches with fried chicken, all the good stuff that, makes you want to get up early so you can go indulge a little bit. I know you're an early riser.
Yes, I am.
So,
and I do love a good breakfast.
I know. I woke up this morning, and I think it was already, I had the email before I woke up, but it was sometime 6 o'clock sometime this morning. I already had an email from Ed being like, we're all good with your taxes. Everything's good to go. And I'm like, my goodness, this guy works all the time. So there's, you can get up early, and you can go indulge in some breakfast over in Vienna now.
Keeps me moving.
I know, exactly. So, all right, so that, like I said, I wanted to keep the news a little bit short today because I wanted to give Ed plenty of time to talk to us about why he came in, which is really kind of focusing on that 1031 exchange and the changes that have come for that.
Alrighty. So my goal in this talk is to hit a few key overreaching items. The first is to kind of explain what a 1031 exchange is, why it matters, how it ties into the normal strategies involved in investment properties. The second is to hit some of the more recent changes, such as in the 2017-18 Tax Act, some changes they made to that, and then to hit some proposed changes that could be taking effect based on what President Biden was saying during his campaigns. Those have not happened yet. They are not yet even in proposal as an official proposal, but they've been talked about, and we're starting to noodle through, hey, if this happens, we need to be prepared for it. So first, the purpose of a 1031 exchange, kind of the history of it. A 1031 exchange or a Starker exchange simply says, in essence, when you sell real estate and you immediately buy other real estate, it would be nice to not have to pay tax on that sale because you're reinvesting it back into new real estate. That's the heart of where the whole thing came from. It was involved with a whole bunch of other stuff besides real estate, such as it used to be you could do it with partial ownership in planes, franchise fees, businesses, all sorts of things. But one of the changes that happened a few years ago was it was narrowly focused to real property. This is a very important thing because real estate investments, be they rental properties, investment properties, hotels, businesses that are primarily real estate focused, tend to be what's called a tax shelter in essence. What makes something a tax shelter to a professional like me is that you end up getting a larger deduction for the expenses inside of the business than the cash flow you have to put into that. The reason you get that in most real estate investments has to do with the idea of depreciation as an expense. You buy $1 million apartment building. You buy it, you finance the whole thing. Your mortgage payment each month is not an expense, but the interest associated with it is, as is the real estate taxes, so on, all of which might be incorporated inside that mortgage payment. Because most mortgages are designed to have the same amount of payment each month over the entire term till it's paid off, this means that mathematically you're paying far more interest in the first 10 years than you are in the last 10 years as the loan gets paid down. That means the majority of what you're paying on that mortgage ends up being a deduction. At the same time, you've bought this $1 million asset. The IRS doesn't let you take $1 million and write it off that first year because, well, we would abuse the heck out of that now, wouldn't we? And my clients would never pay taxes again. Darn it. Right. And they might have literally limited that because of things like that back in the 60s, but that's a different talk. So you get to take that deduction over a certain period of time. With residential real estate, you're talking about roughly 27 and a half years. With commercial real estate, about 39 years. So in that $1 million property I was talking about, you could have a $30,000 deduction a year from that is not cash out of your pocket, which could be far more than the principal you're paying down on the loan, especially if you have an interest-only loan. So you end up with a much larger deduction than the cash you're putting in, making it a tax shelter. There's lots of limitations on how you take that deduction, so on, but because of that, you have a buildup of wasting away of that asset, that depreciation, so that when you sell it later on for a gain, you not only have the gain from how much it's grown, but how much of that depreciation you've taken. So if you were to sell that $1 million property 20 years later for $1.3 million, you might pay tax not only on the $300,000 it went up, but on the $600,000 of depreciation that you were taking against your other income during all that time. Suddenly you have a $900,000 gain, and you owe $300,000 in tax, which you weren't expecting. So real estate has always been very interested in how to push off that tax burden. And one of the ways to do that is the Starker exchange or the 1031 exchange. The idea being you take the gain from the sale and you put it into a new property. There are specific rules involved in being able to do that. If you decide you're going to do a Starker exchange or a 1031, the first thing you have to do is you can never touch the money. So you have to have what's called a qualified intermediary. There are services that do this. Mm-hmm. Any money that you're getting from the sale flows to them. You then have 45 days to identify up to 3 properties that you're going to be buying, that you're going to do this tax-free exchange into. You also have 180 days to actually close. This is not 45 plus 180. They run concurrently. One thing that people sometimes get caught up on in a 1031 is they think it's just about the cash. It's also about the loan. So you have $1 million property. You sell it for $1.5 million. You have $500,000 of gain coming out of it. I'm going to pretend you had an interest-only loan and you put nothing down on it. So in that situation, you're getting $500,000 of cash. I'm ignoring expenses. So you say, okay, I have to put the $500,000 of cash into the new property or properties. You are also being relieved of a $1 million note that got paid off. So you also need to have at least that amount of loans on the new properties. As a relief of debt to the IRS is the exact same as receiving cash. If you get any cash or you get a relief of debt that isn't replaced with additional debt on the new property, it's technically it's what we call boot. And boot is the relief of debt or the cash that actually goes into your pocket. And if you have any gain from the sale, you recognize gain up to your boot. So if you end up buying a new property, you put all the cash into it, but you only have a $900,000 loan on it, and they relieved $1 million, then up to $100,000 of gain could be recognized if you have that much gain on the sale. So it's very important to plan these things out carefully, or else you could completely reverse everything you were trying to do. Now,
and just to be clear, you can take that $1 million and split it up into multiple properties. It doesn't have to be the exact same price of what you were.
That is correct.
Selling off.
The rules used to be loose in the types of properties you could do this with. So with the 2017 Act, they narrowed it more, and it has to be investment or business property. You can't do it with your primary residence. You might be able to do it with a vacation property or something like that, but it has to have become an investment property or a rental property to do that. The IRS is extremely suspicious of people doing 1031 exchanges because there's a lot of money involved. And they know there's a lot of incentive to create a way to avoid the tax on it. So, in general, it needs to be the business property. If it was not a business property before, you need it to be a business property as in being rented out for at least 6 to 12 months. They have safe harbors in place. A classic one that people like to do is to sell their investment property and buy a property in where they plan to retire. And you're allowed to do this as long as it's actually an investment or rental property when you buy it. The IRS really says they want to see that thing being rented out for at least 12 months, preferably longer, before someone was to move in because things change. Now, you can't go into the intention of doing that,
Right.
but the facts can still be allowed to go that way, but you have to follow the rules.
So let me ask you this, because I think one of the things that you might be seeing a lot of is people have, you were talking a lot about vacation homes. So people up here, it's not uncommon for them to own a beach property. And they own it, they are only renting it out maybe in the summers. Does that still,
What it
how does
boils
that
down
timing
to
figure?
there is how many days they're using it personally.
Okay.
In a perfect world, they would never be using it more than 14 days during in the year that we're saying it was a rental property.
Okay.
That's kind of the gold standard. They'd want to be renting it out for multiple months. You can have a rental property that you only rent out for a few months a year because that's the high season, that's when you
Right.
make money off of it. The question is, are you personally using it during that period? And if you want to do a 1031 exchange, don't personally use it for that year.
Okay.
Now, in general, the goal of using a 1031 exchange in most cases for smaller real estate clients, people who have a few rental properties, an investment property, things like that, your goal is to never pay tax on it, on the sale. That's it. You'd love to do that. And the way that most people do that has to do with what's called the step up in basis. You want to pass it down to your kids. When you do that, it goes to the estate tax system. Assuming estate tax stay where they are now, which unless you have more than $10 million in assets, you're not going to be taxed on it. It immediately steps up in basis. So I bought a house for $100,000 20 years ago. It's now worth $500,000. If I sell it, I'm going to have $400,000 of gain that I'm going to have to pay tax on. If I pass away and it goes down to my kids and my assets are below $10 million, I'm not paying any estate tax, and they inherit it at $500,000, the current value.
Okay.
They then turn around and sell it, zero gain.
Oh, because
Big
right,
deal.
because that they
Yeah.
inherited it at that higher
Yep.
price.
So when you have multiple properties, the purpose of real estate is to be leveraged to buy more real estate when you are in the business of real estate investment.
It's like Monopoly.
Yeah, it's a long-term loan. There are tax advantages to having it, and it tends to be a very low interest rate because it's collateralized against the property.
Right.
So, in a perfect world, you buy your property, years pass, it increases in value, you realize you want to have a different investment property. You sell that property, you tax-free exchange into the new property, the two new properties. You then realize you want more, and there's this huge amount of equity in the property. You refinance and pull the cash out of the property, not a taxable event. You then use that cash to do your down payments on other properties. And you keep doing this for 40 years. Then you've got like 15 properties, all this equity built up over time. You peacefully pass away, and everything passes down to the next generation. No taxes. All the gains are non-taxable. You still have to watch the estate tax. You have to make sure that's going to be working. But that, at the heart of it, that's what people want to be doing.
Mm-hmm.
That's what they want to be catching. Now, there's a lot of nuances to this. For instance, there used to be something where, you still can do it, you do your tax-free exchange. And one day after you do it, you pull all the money out to buy your other properties.
Mm-hmm.
Okay, that's not boot. Technically, you're allowed to do that. In theory, you can do a same-day exchange where you refinance it the exact same day you sold the property. Technically, you're allowed to do that. Practically speaking, the IRS has said if they catch that, they're taking you to court. They don't care if they lose.
Yeah.
They just do not like it. So you have to plan these things out carefully as doing it, looking at both the cash flow in the rental properties, how you're going to utilize the equity inside of it, what your end goal is for these properties over a long period of time, while trying to push off tax payments as long as possible while not being silly about it. For instance, right now, there's a 0% tax rate on capital gains if you're in a certain income tax bracket. That would mean I would not want you to do a tax-free exchange if I'm not going to pay any tax on the gain, or if your property dropped in value. Why do a tax-free exchange if it's a loss?
Right. Oh, I don't know many that are dropping in value right now.
Right now they're not.
Right.
But everything that goes around comes around.
Exactly.
I'm
that
sure
is
we'll
very
see
true.
it again.
It will. It's cyclical. It's going to happen. It's just a matter of when.
That's why you need professionals to help you. So let's talk about some of the proposals that Biden had brought up as potential with his administration, especially since we have Democratic control on both sides, which makes it far more likely for things to happen.
Mm-hmm.
It has been directly stated that essentially they don't like the tax-free exchange.
Mm-hmm.
They think it's something that's used primarily by wealthy people to move to using some of the things I just said to avoid paying taxes and keep generational wealth. One proposal is simply to eliminate it entirely. That would surprise me a little bit because there's good reasons it exists, and there's large lobbies against that, and it's a razor-thin piece. A more interesting one has to do with disallowing the exchange if income is above a certain point. The number I've seen thrown around is 400,000. They seem to like that number.
Mm-hmm.
That becomes really interesting because that means if that happens, you have to really control your level of income in each year, the years that you're planning on doing it. And you might have to go back to some other mechanisms of minimizing tax than using 1031 exchanges. I mean, the classics are the installment sale, where if you do your sale correctly, you don't recognize all the gain immediately because you're being paid over a period of time. Right. There are several things you can do like that you kind of have to get back to those methods. That's its own 30, 40, 3-hour talk, so I'm not going to dive too much into it.
We don't have that much time this morning, right?
Yeah. The big thing about it is if the other talk is to change or reduce the capital gains tax rate, that matters a lot.
Yes, because that affects a lot of people. Right
now, capital gains are, if you really shake it, around 20% if you're high income people, with whatever your state tax rate happens to be. The talk they've been throwing around is trying to leave capital gains rates as they are unless you make over a certain amount of income and then essentially turn it into ordinary income. Now, why does that matter? That matters because if you're dealing in California or New York, for instance, this could literally move your tax rate up to in excess of 50% of the gain. Woo! Which is a lot of tax to have to pay in if you haven't planned on it. Right. And it's especially dangerous inside of real estate because if you've done a few tax-free exchanges, you've refinanced it to pull money out to buy other properties, you've been cheerfully following your strategy, I have certainly seen situations where the tax owed on the sale is far more money than the cash you're getting out from the
Right.
sale
Right.
because you've dumped it into other properties.
Right.
In which case, you have to start planning, how am I going to access that cash to pay off this tax?
Right.
So very important to pay close attention to any tax acts coming out of the administration so that you can do planning for it.
What would be the typical, like, if they do alter the capital gains tax rates and everything
Yeah,
having
which
to
they've
do with
done
capital
historically.
gains? Right. How long of a time frame? Because I mean, you would imagine it can't be like it's happening now, and like they have to give like notice.
Oh, no, they don't. They don't have to do a darn thing. They can do whatever they want.
So it could
Now,
be just in. I mean, because, but that's just. I mean, that's a lot. Like you
now
said,
they
it's a lot
usually
of planning.
give notice.
Okay.
And also, usually, tax acts take a really long time. The big tax act in the 80s took 2.5 years of negotiations.
Right.
And that was with, imagine this, you had the Democrats coming out saying, we totally agree with the Republicans, we need to fix our tax code. It's hard for me to imagine them saying that. And while in agreement, it took them 2.5 years to come up with how they were doing it.
Yeah.
But the last administration showed us that if you control enough of the House and the Senate, things can happen really
quick.
fast,
Right.
and sometimes with not that much thought into
Right.
it. So most likely, because of how razor thin the margins are, I would think a tax act that really hits these things would have to be very carefully set up to have as minimal impact on a lot of people as possible to have any chance of going through. Like I personally, it's very hard for me to imagine a 1031 being able to slide through very well this year, simply because the lobbies would be very strongly against it, and it's esoteric enough that normal people don't quite know what it is,
Right.
so it could slide away. On the other hand, adjusting capital gains rates so rich people pay more tax, I can see
Right.
something like that shoving through pretty quickly. The hope is they give us at least to the next tax year to plan
Well,
for
and
it.
that's what I mean.
Because we're past when, or we're coming close to when the first set of estimated taxes need to go in.
Right.
And if they change the rules on us mid-year, it's really hard for us to know what's
figure it
happening.
out. Exactly.
So one would hope they push it.
Right.
But they can do whatever they want.
That they can.
Yeah.
Yes, they can. So, any last items in regard to this, or
It's
I mean,
just-
it's very. There's so. I mean, you could talk for days.
I think
On this,
I think
but-
my last piece would simply be, if you're involved in a situation that could potentially have 1031 stock your exchanges using real estate in your wealth development portfolio, you need a plan.
Mm-hmm.
You need a plan in place that you're actually following, so you kind of know what it is your goal is, what is you're trying to achieve with this, so you can measure it properly. And then you need to pay attention to the tax changes as they do, so you can adjust your plan
Right.
and adjust timing of when things happen.
Yeah, that is very true.
So, you
like
need
everything in
professionals.
life.
Mhm.
Like everything in life. So, Ed, thank you so much. That was very informative and so important, especially. I know before we started talking, it was, kind of putting it in layman's terms. And I know some of you might be sitting there thinking like, oh, these are only big real estate investors and, these big companies where that's their whole goal. We work with a lot of people who do 1031 exchanges who are just like your neighbor. They happen to own, a couple rental properties and they're, changing stuff up a bit. So it's not a term you hear often, but it happens more often than you think.
It's very common. I have it
Especially
with
in this
lots
area.
of smaller clients. I'll give you an example. I had a client who owned 4 rental properties in Virginia, and they were retiring to Florida. So over a 2-year period, they tax exchanged all the properties to properties in Florida so they could keep them close to themselves.
Mm-hmm.
This is how you move things to avoid having heavy tax hits without it being planned. It's just one of the tools you normally use, even when you only have 1 or 2 properties.
Yeah, that is true.
Right.
All right. Well, thank you for that. It was
Thank
very
you, Lynn.
informative. I learned stuff as well. I always learn something every time I talk to you, Ed. It's fantastic. So some other things that you can learn. So some of the articles and content that we put up that you can find on our website right now is we did a dive into the new development Potomac Shores down in the Dumfries area. And the biggest thing with this is Yes, it is a big residential area down right along the shores, right at that Woodbridge Dumfries kind of line. But it's going to be something huge for the region because it's going to be a big mixed use development that is not just for that specific community. The Ali Krieger Sportsplex is down there. It's open right now. That opened in 2018. They're going to have this beautiful river walk with this whole commercial area. So take a look at that. You can see what is coming up. We also went ahead and took a look at a $635,000 townhome right in the Vienna area and broke down those numbers for what you can expect a mortgage payment to look like and for you to understand what kind of property you can buy in a certain area for that price range. So like I said, that was a $635,000 townhome in Vienna, walking distance to the metro. And then lastly, Ingrid took us on a little tour of closing costs and down payments in our top 3 takeaway. So if you are in the market to buy or thinking about buying, those are super important topics for you because that is how much money do you actually need to be able to purchase a property, regardless of what your loan amount is. So take a look at that. And then coming up this coming week that you can look for, we are going to do a deep dive into the monthly stats for the month. However, I do want to point out, so I know everyone knows the real estate market right now is absolutely crazy. It's crazy because inventory is low. Now, what I'm about to say is going to get a lot of people excited, but I want to put a caveat on that of inventory will still be low. However, we had numbers come out from just this past week, and we're already seeing the tick up of how many properties are coming active.
Spring has sprung.
Spring has sprung. So we are seeing more inventory coming on the market. It's still a low inventory market. So you're still going to be seeing, multiple offer scenarios when it comes to a property. But because more are coming on the market, you might not be getting 85, 30, 20 offers. You might only be up against competition of maybe like 10 or 8, maybe 5. But that is loosening a little bit. And then also, like we spoke about last week, mortgage interest rates have ticked up a little bit. And that is going to take some people out of the game of buying because of that. And also you're seeing some people come out because they have been trying to get a place and they're just they want to take a moment. They want to take a moment, so they might be coming back into the market a little bit later. But the nice thing is we are already starting to see that inventory tick up. We are also going to take a look at a $285,000 condo in Alexandria. It's a 1-bedroom, 1-bath, actually in the Palazzo community. That's right over in Shirlington. And then we are doing a nice tour of Fairfax City. So we're going to spotlight that city, and we are going to take a look at some of the restaurants down there, the boutiques, and so much more that Fairfax City has to offer. So make sure to look out for those. And then coming up this week, actually this weekend and this coming week, for our specific events, we have 2 open houses, one of which is at that $285,000 condo in the in the Shirlington area. And I am going to be there, and Ingrid is going to be there one day. Both days we are going to have an in-person open house from 2 to 4, so definitely make sure to check our social media and our website at focusonnova.com/events to see those. We also have an open house on another condo that we have over in the Vienna area, actually more specifically that Merrifield Mosaic, very sought after area, right on Gallows, and that is also a 1-bedroom, 1-bath, and that's coming in at a price point of about $355,000. So that condo we will be holding open houses in person from 2 to 4 both Saturday and Sunday. Now you can catch me right here on Facebook Live, doing some Facebook Live open houses. For those of you who can't make it out personally, I'll be giving you guys virtual tours for those as well. And then lastly, we have our happy hours coming up this week. We have our seller happy hour on Thursday from 7 to 8, and then I will be hosting that one, and then Tracy is going to host our Saturday morning seminars for both sellers and buyers on, obviously, Saturday. So she's going to be hosting those. And then it is so nice out. It was, what, 70 something degrees yesterday, and I think the high's supposed to be somewhere in the high 60s today.
Ooh,
But
not for long.
yes, next week it is apparently supposed to drop down into the 40s or 50s, which, I'll give Mother Nature that. I'll let you, you're slowly getting started warming up. I'll let you have a little pause. But since this weekend is going to be nice, the State Theater on Saturday starting at 5, and it's free, they are going to have the free-flowing musical experience, which is an acoustic band playing outside. So it's just, I just love music, and I love music outside. So that's just going to be really relaxing, so you can take that in. Everything from jazz to rock to like all types of music genres. So check that out. And then if you are really wanting to get into the spring spirit, especially with your decor, there's going to be a floral design workshop at Green Spring Gardens on Saturday at 1 o'clock, and the fee's $35. But you can go support a local park with their workshops. So go ahead and do that, and you get to walk away with some nice floral design decor for your home. And then lastly, March 14th is Pie Day. And how better to celebrate it than pairings of pies and wine? All weekend long. I know. All weekend long. 868 Estate Vineyards is holding a cutie pies and wine tasting all weekend. So, and that's where they're going to, like I said, be pairing different pies with wines. So go ahead and check that out to celebrate Pie Day. And that's what we have for today. Ed, thank you so much for joining me. Do you have any super exciting plans besides looking at taxes this weekend?
I will be working and thinking of you guys out there enjoying yourselves and maybe not liking you.
Well, on that note, go make sure you have a fantastic weekend so Ed can at least vicariously live through the rest of us. All right. Thank you guys. Have a great weekend, and hope to see you on our virtual open houses or in person at our virtual open houses, or at our in-person open houses this weekend. All right.
Thank you.
Have a good one, everybody.